And then we'll put it in year, because again, I've got slides, but I always talk before the slides, and sometimes I find stuff in the slides I didn't know. It's pretty amazing. Canada versus the US. People always ask me, why is Canada different? The Canadian stock market didn't peak in October of 2007. The Canadian stock market peaked in June of 2008. Why? Canadian stock market is largely impacted by price of commodities. Summer of 2008, the price of oil, if you remember, was $147 a barrel. Apparently on its way to 200, never made it to 200, just reversed back and went back to its low 20s. We went from $147 a barrel to about $27 as the world economy was going to a recession because of that financial crisis. And the financial crisis, even though it was triggered by the US, was a world financial crisis. The world is globalized. Financial institutions in Europe were impacted by that crisis also. All right? So we peaked in June, came down 15, came down again, and then we made the low at the same time as the US. March 9, we rallied 88% instead of rallying 100 because we came down less. And lately we're coming down more than the US. Why? The Canadian stock market is largely impacted by world economy, and what people are saying today is the world economy probably will slow down compared to what they were expecting about a year ago. All right? December to January the 31st, 4.2% for Canada. The rally from the October low, 19 United States, only 11% in Canada. But I'll take it. I said, you really locked the door? You leave, you can't come back. You leave, you cannot come back. It's not me. It's not me.
I'm in for the long run.
You're in for the prices, eh? You all guys came in for the food, the wine, and prices, and then you have to listen to me? That is great. Okay, so let me walk you through, again, the importance of having a plan. These are the major, when you look at the major asset classes: bonds, Canadian equities, U.S. equities, international, and I put emerging markets, which are becoming a larger share of the world economy. And emerging markets eventually will become larger and larger and larger. Very volatile, but that's where the growth is. Just want to show you you remember 2011, everything was great. People said, well, don't have bonds in your portfolio because rates are so low. It is not the time to be invested in bonds. And then when the economy started to weaken, usually bonds do well in that environment. So 2011, in spite of all the specialists beginning of the year, except me, because I remember I look up my slides every year, and I always come back to do presentation if I've been right from the forecast I made the previous year. I always say that. And in Toronto, it's been 7 years in a row, so eventually I'll miss it. But again, but beginning of the year, I think people were too optimistic, and I say, guys, keep bonds in a portfolio. I don't know, there might be some situation in Europe that could derail. Anyway, so bonds last year, save your bacon. They were up 9.7% when equities were down. Canadian stocks were down. U.S. stock market up a bit, and we'll talk about the U.S. later. We're starting to see the U.S. moving out of that scenario, out of the doldrums more rapidly in other countries. International equities. So the point I want to make is bonds last year, that's why you should have them in your portfolio. When you're expecting that everything's going to be great, sometime you're wrong, and they save the bacon for you. At the same time, equities didn't do well. And I'm putting a circle around Canada and emerging markets because I think there's more and more relationship or correlation between that. Canada used to be largely influenced by the behavior of the U.S. economy. We're getting more and more influenced now by the demand for our commodities than we are from the U.S. And that's coming out of China. So 2011, not a great year beginning. The rest of the year was not so good. But if you had a plan, it was great because you were selling. So I was selling bonds for you and was buying equities when they were going down. I didn't ask your permission again. I'm allowed to do it.
Excuse me.
Yes.
Why is there such a difference between the Canadian equities and the U.S. equities, especially if China is driving our demand, and there's a lot of demand, and so why are we so low?
But the demand in 2011 really slowed down. China is slowing down.
Oh.
The price of copper has come down. The price of oil came down. Gradually starting to increase again, but from the beginning of 2011 to the course of the year, we saw the price of commodities going down because people were expecting that China would continue. China was growing at 10% for 20 years in a row. In 2011, they started the year growing at, I think, like 9.7%. The second quarter came out at 9.4. The third quarter came out at 9.1, and the fourth quarter of 11 came out at 8.9. They're expecting the Chinese economy to grow about 8%. 8 is better than 1. All right, we agree. 8 is great, but when you're used to grow at 10, growing at 8 has an impact at the margin on the demand for commodities. All right, so it's having, and the U.S. is gradually, U.S. multinational are doing extremely well in that environment. The U.S. dollar is down, they're now becoming more and more competitive. So anyway, so I want to walk you through that. Okay, 2011, bonds as a cushion against equity. 2010 was a great year for equities. Canadian stocks were up 17.6 because of China, Canada outperforming the U.S. Canada behaving more in line with emerging market. 2009, the same thing. Canada doing 35% because emerging markets were doing well. China, India, every emerging economy is shooting the lights out. U.S. only growing at 8. But the point is, it's choppy from year to year. It's choppy from day to day, from month to month, to quarter. But if you have a plan, you see that over time, one asset class, one country, one industry will do well, and another will not do as well. We rebalance constantly. That's this recipe for success, is rebalancing your portfolio and sticking to your game plan. All right? But if you look at the last 3 years in a row, if you would have had that portfolio, stocks gave you 13, same number as emerging economies, U.S. only 7. You're not surprised that international equities are down, are up only 1.7. IFA means Europe, Australia, and Far East. You know what's happening in Europe, right? So that's the game plan. The game plan is markets fluctuate, and you need to have rebalancing, and that's what we do in the portfolios. People ask me, why is Canada done relatively better than other countries? We've seen a lot of people over the past 7 or 8 years change their strategy. Canada is great. Yeah, it's a great country. Relative to others, we're doing extremely well. And then why should I diversify when Canada is doing so well? Well, you should diversify because sometimes Canada is exposed to certain factors, which I'm going to show you later. We're less dependent on the U.S. than in the past. We're still dependent on the U.S., depending on where you are in the country. I was in Windsor, Ontario about 2 months ago. From Windsor, you look across, it's Detroit. Lots of empty warehouse to rent. And big warehouse. The trains are passing through the warehouse. Huge. 500,000 square feet. Right? Huge. Finnish, Chrysler, all these firms are gone. Right? So we're less dependent on the U.S. Canadian economy is more cyclical. It's a function of demand for and then I'm going to show you that I picked a chart or a graph or a table to go and outline that to just prove you I'm right. Energy and natural and other resource companies account for about half the TSX. Industrialization of China has benefited the TSX, not just Canadian economy, the Canadian stock market. Australia, New Zealand, Brazil, countries that are sitting on resources today are doing extremely well, will continue to do well. The industrialization of China is only beginning. China is at the same point the U.S. was in the 1870s when they were building the railroad and building all the infrastructure. So this cycle is intact, but it's not going straight up. It's going to be volatile. All right? Canadian dollar has risen. Remember, Canadian dollar in 2002 was 62 cents. It's now par. It went over par in 07, and it's going to go over par over the next couple of years. Next week, I have no idea. 3 months from now, I have no idea. 3 years from now, Canadian dollar will be higher. The price of oil 3 years from now is going to be higher than it is today. There is demand for resources, and there's a limited supply. You probably can't see the back, but what it is I'm comparing the Toronto Stock Exchange. You can see my age. I'm still talking about the Toronto Stock Exchange, TSC 300. It's called the TSX now. Standard & Poor's and the World Index, MSCI World. And we break it down by industry. In Canada, when you look at the companies that are in the energy sector and in materials or other resources, 27.1 plus 21.0, whatever calculator, I'm part of the older generation, can do it. 48%. Young kids can't do that. What is this number? I can't. Twit my friends so they may tell me. Yeah. So 48% of the Canadian stock market is tied to energy and natural resources. So when the demand for these resources is going up, we're doing well. When the demand for our resources is not doing well, we do poorly. Look at the U.S. stock market. U.S. only 15% of U.S. companies are in these two sectors. So when we talk about diversification, that's what we mean. When you are in Canada, you're not very well diversified. You've got half your portfolio in energy and material, then you got about 30% in financial, which are the banks financing these guys. If you're looking for information technology, in Canada, it's 1.3% of the index, and that's RIM. Used to be 2.5, gradually going down. I'm not making any call on RIM, but that's the fact. So if you want information technology, you ain't going to get it in Canada. You got to go to the U.S. In the U.S., information technology is 19% of the index. So we talk about diversification as you buy outside of Canada what you don't have in Canada. And that's the way we run money these ways. So it's irrelevant if it's Canada versus... So if you're investing in the Canadian stock market and you're buying resources in Australia and you're buying resources in the United States, you're overdoing it. You're already overexposed to the area. Buy it, and that's what the money managers are doing. We make sure when we put a portfolio with a Marquee or some of these solutions, we make sure we diversify by style so that we don't have the same manager buying the same stocks. If you put a bunch of Canadian money managers together, they will own the same stocks. They're going to have Royal Bank and TD and the majors. They're going to own this. That's why you diversify. All right. If you're looking for healthcare in Canada, you're going to be searching a long time because it's only 1.4% of the index, whereby in the United States 12%. That's what it's all about. So the Canadian stock market is very cyclical. It's a very good presentation. I'm going to be running out of time. All right. So this one, I just want to show you this relative performance. I put when the thing is going, it started in 1950. When the line is going up, it means Canada does better than the U.S. You can see that over, what is that, 50 years? Is it 50? 60? 60 odd years. The only time that the Canadian stock market does better than the U.S. is that when there is commodity inflation. We got that in the 70s, and we're getting that now. Okay? That's the only point. Why did I put that slide? I don't know.
What causes the inflation?
It was, first of all, over here, in the 70s, inflation was created again. The world was not globalized. It's a long story. It was after the Vietnam War in the 60s, and then we started to print money to go and finance that. And then we gradually had a bit of inflation. Inflation really started in 1973 with the first OPEC crisis. The price of oil started to go up. Remember what the price of a barrel of oil was in 1973? Anybody have an idea? It's now $100. It was 147 at the top. It was $3. The price of a barrel was $3 a barrel. And it went to 35. Created inflation. Inflation through energy. And at the time, because the world was not globalized, people were able to go and negotiate wage increases to protect yourself from rising prices. All the negotiation, all the pension plan deals were what we call COLA adjustment, cost of living adjustment. So if there is inflation and then you're able to go and get a higher increase to go and protect your purchasing power, then you raise prices again, and then you raise salaries, and then you go into an inflation environment. And then so there was the first OPEC crisis in 73, and the second one was 1979 with the Iran situation. Inflation got out of control. Inflation was 12% in 1980. Interest rates followed. If you had a mortgage in 1980, you remember what the rate was, 21%. And if you had a little bit of savings, and you had Canada Savings Bond, 19.25. So rents went higher because of inflation. And then Volcker came in the United States and said, well, this is unsustainable. We got to go and raise rates because if we can have an economy that's going to be running with 12 or 14% inflation. So gradually we had an erosion, and inflation went from double digit to about a couple today. And interest rates went from 18% to 2% today, and 0% on cash. A 10-year Government of Canada bond today is 1.8%. All right? Very difficult for us as investor. How do you put your money? We're getting older. There's the demography coming in. You've got a pool of money. In the past, when you were able to go with 7 or 8% on your cash, was cool. You do 7% on the money I have. I'm cool. I'm okay. Now you need like $7 billion to do decent living when rates are 0. You get the message. All right. So it was inflationary. So let me put it in gear because we promised us. Are they locking the door at 7? If we do not finish it, is anything's going to explode at 7?
No.
Okay, so it could be 7:05. Okay, so because I get excited about the stuff I do. Sorry about that. One guy said to me, Mark, can you get more passionate about the way you present? I'm working on it. When I do it in French, even better. So the second part's going to be en français. Okay. Okay, no. People, they're leaving. It was a joke. It was a joke. Don't leave. All right, so let's put it in here. So 10 minutes, I'm done. All right, so repeat 2012, a repeat of 2011. In terms of choppiness, yes, it's going to remain choppy. It's going to be, the trend is better, but there's still some uncertainties around the world, and we can have, one day we can wake up and then Greece can say, we're not paying you back. It can happen. Okay, they're trying to give money to Greece so Greece can pay you back. It's like having a cow. You're milking the cow, and you take the milk and you put it back in the cow, expecting the cow will give you more milk. Let me think about that.
You're not a farmer.
you raised the tape. It doesn't make any sense. And I have not had a glass of wine. That's the reason why I make no sense anymore. After a glass of wine, I make a ton of sense. Volatility will European sovereign debt issue has not been resolved. Yeah, they're getting their act together. They're finding a way. But it's still unresolved, and that's why there is still some uncertainty. That's why at the end I'm going to tell you, we should, even though things are better, there's still room to be a little bit more cautious than we would be if the debt situation in Europe. If the debt situation in Europe would have been resolved, I would have been here saying, time to buy, this is great, fantastic, we will do well. I'm going to say, great, it's going to be great, but there's still some uncertainty. And in terms of uncertainty, I always like to have a little bit of powder dry and keep a little bit of cash aside to take advantage. And maybe I'm going to be wrong. Maybe this thing will continue to go up forever, and great. But maybe if there is a correction, I'd like to be able to go and take advantage of it. This being said, there are opportunities to make money, take advantage of disparity. The world economy is not working in synchronization. You're getting a completely different scenario. I'm going to put it on the table later. Diversification, rebalancing would be more important than ever. And active management, you need people that are running portfolios. You cannot just go and buy something and sit on it and expect that over the next 12 months you're going to do okay. If you would have bought, it's called range bound. If you would have bought, take a Microsoft for example, and it's perfect. I'm not making a recommendation of Microsoft. If you would have bought Microsoft 10 years ago, the price stock Microsoft today is the same price it was 10 years ago. Walmart is now trading at $62. 10 years ago, it was trading at $57. If you put a chart together, you can have a site called bigchart.com. Look at it. Put it on the chart. 10 years. When you have a market, when the market is going up straight up, and if you have a bull market, stocks do okay. 1982 to 2000, everything was going up. 2000 to today, markets are going sideways. They're going up and then they're going down. They're going up, they're going down. So the old strategy of just buying a stock and forgetting is going to do okay doesn't work anymore. You got to be more active. You got to rebalance your portfolio if you're going to be able to generate some revenue. And this is a table I put together. Again, you can see the matching of the color of the blue with the blue of the logo, which is really amazing. Even the font I'm matching. It's really amazing. So it's so easy today to do PowerPoint. They do it for you. The color comes automatically. It's just great. You look like a professional. So what's happening? So let's put there's three major blocks, and I put Canada at the bottom. There's the U.S. block. Things are improving. Things are gradually improving in the United States. Of course it's improving. Interest rates have been 0 for 5 years. I hope it's improving. If not, it will never improve. The downside risk has been reduced. And then the stock market is now, after the stock market correction of 2011, thank you for coming by. It's good for my ego. The market is becoming more attractive. Europe, it's a basket case. I say it's deteriorating. The downside risk is increasing. Valuation stocks are extremely cheap. So some of our money managers are looking and say, well, I can buy this company at a cheap price. The thing is, it can become cheaper if they go into a recession. So I'm saying attractive, but downside risk is high. And it's probably the only region around the world that is creating problems today. If they can get the sovereign debt issue resolved, this is going to be great. But it will be resolved. We don't know when and in what shape. China, deteriorating conditions slowing down, pricing is attractive if the economy doesn't go into a recession. China's not going into a recession. And Canada's stable, downside risk is limited because on the one hand we're benefiting from what's happening in the United States, and on the other hand we're benefiting from what's happening for demand for our commodities. Yes?
Mark, I wonder if you could comment on domestic debt, both government and...
Yeah, that's, again, Canada, domestic debt, Canada versus other countries, we're looking better. And that's what people are doing today. They're not focusing on one country, they're looking at relative. They're looking at Greece versus Portugal, Portugal versus France. Lately in the fall they started to attack Italy, and it forced the resignation of the Prime Minister because again the guy was total gong show. But again, Italian. And have a glass of wine, it's not fun, bring the ladies. That's the way it is, that's in their genes. There's nothing you can do. Yes?
So just on that, what about U.S. debt?
Let me just finish that, I'll get back to the U.S. So in relatively, Canada, the debt ratio, the level of debt as a proportion of GDP, Canada is still, it was not managed. In 1994, and he mentioned Canada was a basket case. It was a total basket case, lost its credit. And then the governments came in, and the Canadian dollar, they took advantage of the Canadian dollar was lower and allowed Canadian companies to become more and more competitive. We got out of our mess and we're now AAA. So Canada, relative to others, doing better. Why? Because our economy is benefiting from demand for resources, so we're well endowed. Our financial institutions are more solid than the financial institutions around the world. And the guy who's now running the facility in Europe that is supervising all the banks, Mark Carney, is the governor of the Bank of Canada. So they pick a Canadian to be in charge of supervising all financial institutions around the world, which gives you a good idea of what credibility Canada has. So relative to others, we're doing okay. In Canada, people are starting to be perturbed, and the Bank of Canada is worried about the level of debt, especially in housing. People have been taking advantage of very, very low rates to go and take mortgages beyond their capacity. So any increase in interest rates could have an impact, and that's why you saw over the past 6 months the governments, not the government, but the banks saying, we're not lending you forever now, we're going to amortize a lower period of time. You want to continue to borrow at the short end and borrow floater, you got to qualify for a 5-year fixed mortgage. So they're starting to get the thing together. And there was a good study done by the economists of Bank of Montreal, Sherry Cooper, on the relative attractiveness of Canada real estate versus the U.S. And she says, yeah, it is pricey, but again, we've got a different environment. We've got a completely different environment than the U.S. So Canada is doing okay. U.S. deficit is an issue, but the U.S., see again, if you're an investor, you say, okay, can they get out of that? Can they fix their problem? They cannot fix their problem until they get an election. And the Americans will only change their way when they're forced to change, like everybody else. But the difference between the U.S. and Europe is the U.S. control their currency. In Europe, you've got in the same basket Spain, Italy, France, Greece, and Germany. Completely different economies, one currency, and they don't control it. The U.S. control their money. They can print as much as they want, and they will print as much as they want. Point number one. Point number two, the lowest tax rate is in the United States. If the Americans tomorrow decided to fix their problem by raising taxes and putting a TPS or the value-added tax or whatever, within 3 years they have no deficit. And don't forget, they've been running a war in Afghanistan, they've been running a war in Iraq, they've been running this thing, and they're still, in terms of deficit, within reasonable. But again, Standard & Poor's came in and said, well, guys, get your act together, we're downgrading. So I'm not worried about the U.S. And again, it's interesting to know and to find out that in times of uncertainty, money flows back into the U.S. U.S. dollar is always a reserve currency. You know why? Because they're going to pay you back. The U.S. will pay you back. Of course they pay you back. They control the money. They print it. And the U.S. dollar is the reserve currency. If you are doing transaction in gold, it's priced in U.S. dollar. If you're doing transaction in oil, it's priced in U.S. dollar. If you're doing transaction in the future, it's priced in U.S. dollar. So the U.S. dollar is the reserve currency. Gradually, you need to have a shift from the U.S. to the euro. Would you rather own U.S. dollar today or euros? Let me think about that one. Oh, that's a tough one. I'll pick the U.S. Would I rather own the US dollar than the yen? Well, that's a different story. Maybe yen is good. Eventually, the Chinese currency will be the reserve currency. But China doesn't want to do it today, because if they were to do that, their currency would go up, which will limit and decline and lower their competitive. They are a trading economy. The U.S. consumer is 70% of the U.S. economy. The Chinese consumer is 35% of its economy. The Chinese economy is producing what America is buying. China is producing what Europe is buying. Eventually, you're going to create a middle class. Gradually, you're going to get what? Prices are going up, wages are going up. Eventually, China will become a developed economy, but they are not a developed economy today, and they cannot afford to have their currency go up. That will impact significantly their exports. All right, so that's what's happening. So my God, sorry about that. So I just want to show you a couple of charts. Unemployment rate in the United States is improving finally. Look at the impact of the recession. The unemployment rate in the United States went from 4.5% to about 10%. In the recession year, it went to 25%. So they managed to government intervention to prevent the unemployment rate to go through the roof, gradually coming down. In previous recoveries, it would have been down to about 6%. It's a slow recovery. Housing starts. Look at this. The boom for 10 years in a row, everything was going up, and people were buying houses. As people were buying houses, price were going up. As price would go up, people were buying in. Because I've got to buy it, it's going to go up. I can, buy it. You cannot lose money on a house. Buy a condo in Scottsdale, Arizona. Buy some in Florida. It's going up to you. Buy. And eventually, the music stops and becomes unrealistic, and people start to sell, and then it goes into a spiral. And so we went down to 2007. That's when the market peaked in the United States, and then off it could, gradually improving. So the U.S. economy is starting to do a little bit better. This is the basket case. These are interest rates in Greece, Portugal, Italy, and Spain. Greece has to pay 33% to borrow money for 10 years. 33. Why do they have to pay 33? Because they will not pay you back. So I've got the choice of having Greece debt or a Greece food. Go for baklava, go for some souvlaki. You're better off. It's called diversification. So government will have to reduce services or raise taxes, slower growth. And that's what is preventing today the overall stock market from taking off. It's the situation in Europe. If they fix it, it's going to be okay. Your emerging economies, the economies are gradually slowing down. The problem in China with real estate prices, again, they're speculators. They enjoy speculating on stuff. It's like a casino. It's in their genes. And gradually, I think China wants to slow down. But again, they're starting to see the economy weakening too much, and they're starting to go and kickstart it. So overall, improvement in the United States, problems in Europe, small problems in China, but overall the situation's improving. What are the implications for interest rates? I put that slide up about a month ago, and I said short-term rates will remain low.